taxes. Isn't it exciting? Holy cow. Right here in the tax season, we're going to talk about taxes. So I have this cartoon up here. You all have had a chance to read that. We're going to talk about the tax laws for 2019 returns. We're in 2020, but of course we're doing last year's tax return, and plus this is usually the time of year when we not only have to do our tax return, but we're kind of thinking about what we need to do for tax planning, if anything, in the period ahead. Now this slide says ground rules. Jot down your questions, and we're going to answer them later. That's not a good idea in this tax program. If you have questions while I'm talking about something, go ahead and ask them. And then to try not to annoy ourselves, we probably want to make sure our phones are off as much as possible. And as you guys probably know, I'm an attorney, I'm a CPA, and I'm a financial advisor. I was in the Army for 20 years, and then when I retired from the Army, I went to law school. And then after I went to law school, we moved to Houston because I wanted to take a job with an accounting firm so I could be a CPA. You can't be a CPA unless you work for a CPA. So that's how I ended up in Houston. And then once you get to Houston, you can't leave, apparently, right? You get here and then you're here permanently. And so that's where the law firm was started, and we have had our office in the Greens Point area for 26 years, since 1994. And we used to be in 333, the building down here, and then we were across the street in 350, and now we're here. And here's the big news. Big news is we're going to move.
Uh-oh.
Uh-oh.
Come right on in. Welcome. Hi.
Sorry.
No problem.
Not further out that way.
Well, let's see. From your place, I don't know if it's easy or not. We're going to be on 249 at Cypresswood. 249 Cypresswood. So for you, you get on the Grand Parkway and come down 249, I guess, would be the faster way. Does that make sense?
Yeah.
Come right ahead, no problem.
When you moving?
We're going to be moving in August.
Oh, okay.
Yeah, so it won't be until August. The other big news is that it's not going to be the Bond Law Firm, it's going to be the Bond and Brown Law Firm. And you just met Chris Brown, he's my partner, so he's going to handle a lot more of the administration in the future. And so I'm real proud to have him aboard. As you may have noticed, he is not only good looking, he's a lot younger than I am. And so for all of us, in case we need help in the future, then hopefully Chris and the great staff we have in the law firm will be here to help us all.
Well, just make it B&B, it's easier.
Right, but it is B&B, right? So then it says, we're members of the American Academy of Estate Planning Attorneys. I like to mention this because this is really a big advantage for our firm and for our clients. The American Academy is a national organization, and it works with about 150 law firms all over the United States, only estate planning law firms. And the purpose of the American Academy is to help those law firms adopt best practices, make sure that the attorneys are up to date, and make sure that our documents are up to date with whatever the latest changes are. They have nationally recognized people on their staff who not only provide education for the attorney firms that are members, but they're the ones that make sure that the software we use and the templates that we use have the latest stuff in it. So this gives us the resources of a much larger law firm, and it makes me more comfortable that we're going to be able to provide the best stuff for you guys. So that's, because if you just have a little bitty firm and you're kind of in your own world, it'd be easy for you to get out of date and stuff. So this is a very important addition to our ability for the family. So these are our three services. We have Bond and Brown Law Firm. We do tax services, and of course, this is a big word. The actual person doing the taxes is my sweet wife. And you say, what does she know about taxes? Well, she ran our Jackson Hewitt Tax Service franchise for 15 years. We had at one time 5 offices, and so she has done or overseen thousands and thousands of tax returns. And she's an enrolled agent. This doesn't mean she wants to do thousands more tax returns, but she does a few through the law firm every year. And then the financial management company is Bond Wealth Management Investments. Okay, so we want to be able to help you with these areas and to answer your questions. And of course, we also want to focus on educational seminars because in all of these areas are really, everybody's interested in this to a greater or lesser degree. We're talking about your estate planning, we're talking about your financial planning, we're talking about taking care of your families. And so this is a lot of important stuff. So for the law firm to do a good job by you, we need to make sure that we're sending out information that kind of lets you know we're here and also helps to keep you up to date. And then we want to have these workshops for our clients. And so we have this workshop facility, and our new office will also have a nice workshop area as well. So we're going to keep going on that. Well, we're going back to the tax issue. So where did the new tax law, quote, new tax law start? Back in the end of 2017, Trump signed many changes to the tax law. And of course, there was all kinds of controversy about it at the time. And some people said it was great, and some people said it was terrible, and so forth. So now the tax law that's in effect this year was essentially the same tax law that was in effect last year. But just to get our bearings right again, what happened was one of the major changes was to change the amount of the standard deduction. And so they doubled it. And so for this year, it's actually $12,200 for singles and $24,400 for married couples. And if you're over 65, this is $27,000. So here's a better slide of this. Here's what it was in 2017. So just look at the married filing jointly. It was $12,700. Well, the tax law changed that to $24,400. And then if you're over 65, if both spouses were over 65, it would be $27,000.
So we have to
for
wait till
standard deduction.
you have to wait till both spouses are over 65.
Yeah, if it's not, it cuts it back by, I forget what that number is. What is this? This is it's by 800, right? It's
26 is the difference. 2,600 is the difference between those numbers.
So 1,300 each.
Yeah, okay.
1,300 each. Yeah. Okay. So anyway, that was the big change, and it is a big change because it affected a whole bunch of things. Before, remember, part of the game was that if you had deductions, if you could take deductions that exceeded $12,700, then you wanted to file Schedule A and keep track of all that stuff, right? You could keep track of your medical, because above a certain threshold, you could deduct your medical expenses, you could deduct your charitable expenses, you could deduct your property taxes and all that stuff. So anytime you could add all that stuff up and it was more than $12,700, then you wanted to file Schedule A because you get larger tax deduction. Well, for a lot of regular folks, once it gets up this high, if you don't have enough exemptions, there's no reason to even keep track of it, right? I mean, it's pointless. It's because you're already going to get the standard deduction at 27 or 24.4. So does that make sense? So a lot of people so one of the ideas of tax simplification was that you didn't have to tote up all your expenses, because now the exemption was so high it wasn't worth the time for a lot of people. Okay, another thing was that they changed the tax brackets and they changed where they hit. So this is 2017, and the 25% bracket for a married couple or a qualifying widower or widow started at 153.5. It's hard to read these things, that's why I highlighted this one. So married, filing jointly, if you were over 153, then you were in the 25% bracket for the amount over 153. So what happened? Now, the 24% bracket for a married couple doesn't even start until you get to 321. Okay, so for most people, this lowered their taxes because it changed the tax brackets slightly lower, and it made the gap, the distance, much wider for those. Now, the other thing on capital gains, so we're talking about long-term capital gains. Short-term capital gains are taxed as ordinary income, so there's no help there. But long-term capital gains, which is more than 6 months or a year, I forget what now.
A year.
Is it a year?
Yeah.
The long-term capital gain is taxed, I'll get into that. Long-term capital gains and qualified dividends. Qualified dividends are like dividends from Exxon, or qualified dividends. Dividends from a company. Some interest from a bank is ordinary income. Distributions from a REIT, a real estate investment trust, ordinary income. But most dividends from regular corporations like Exxon, those are qualified dividends. So if it's long-term capital gain or qualified dividends, there's a zero bracket. So for married couples, if the married couple's AGI was less than 78,750, there's no tax on capital gains or qualified dividends. That's a nice thought. If the income is above 78,750, then you have the 15% bracket all the way up to almost $500,000. It's a 15% bracket.
But only above that 78.
From 78 to 488, it's 15%. And then above 488, it's 20. Now this misstates the problem though. Actually, I would argue that rather than 3 brackets, there are 4 brackets. Okay? So let me explain the additional thing here. So the next slide talks about it. There's a thing called the net investment income tax. A lot of people call it the Obama tax, and it's 3.8% on certain qualified capital gains and qualified dividends. And the place where it goes into effect is for singles with AGI over 200,000, then they pay 15% plus 3.8, so they pay 15.8% on qualified dividends or long-term capital gain. And married couples over 250 pay 18.8 on those things. And then if your income is over 434 or 488, then you pay 20 plus the 3.8, so it's 23.8. So back to here, the reason I said there's really 4 categories. Well, anyway, so you have 15, and then if you have 50, you have 0, then you have 15% up to actually 250,000 for married couples. Above 250, it's 18.8. And anybody in the 20% bracket is going to pay not 20%, but 23.8. Does that make sense? Okay. But notice that
You call that Obama tax, is that the Obamacare tax?
Yeah.
Okay.
And it also affects, 3.8 also affects income that's coming from small LLCs, corporations, and stuff as well. But okay, so then it said, this one talking about tax bracket management. If we're talking about Roths or we're talking about Medicare, so let me show you this. So this is not helpful to everybody, but it's real helpful to some people. Okay, if you're married, and so your income, your AGI is around 170. If you could, you would like to keep it under 170 because your monthly Medicare Part B premium is 135. If you go over 170, then it's 189 a month. So you get a jump there, and if you're married, you get to pay that twice, right? So you get a big jump in your Medicare premium when you cross these different thresholds. So for some people who were just on one side of these things, they get a rude surprise if they go over those thresholds. That make sense? Everybody seeing that?
That's
Yes,
just
so rude.
Right. Yeah.
That's when you adjust your gross income the previous year?
Yep.
Okay.
Just, which one is that? The maximum income, or which?
I think it has a name, but
Yeah, I
Up
know.
to.
I'm trying to figure out which one of those it is, though.
Part-
You know,
Oh,
they've got several there.
Part B, is that what you meant?
It's the
No, the adjusted maximum, in other words, they've got about,
Oh yeah, yeah. We could go on and on. We don't want to know about that.
yeah, I
Let's
know.
keep on.
Well, anyway, I will find that out.
Yeah, they have a whole bunch of ways of different things they do about figuring AGI for different purposes. It's
Yeah.
not, that's something. Let the software. We don't want to talk about that.
Yeah, okay.
That's a level of detail I do not wish to hold in my head. I don't know about you guys. Okay, so then tax efficient income from after tax assets. Okay, I wanted to mention something to people, and you guys may not be in this boat, but I have run into quite a few people who thought that in order to take income out of their investment assets, they needed to invest in assets that created income. Okay, so in other words, if you had a CD and it earns interest, well, there's your interest, there's income. If you had stocks, Exxon stock, and it creates dividends for you, well, then you got dividends, that's for income. If you have bonds, will they create income? Well, that's what you can take out. As if they couldn't or shouldn't take out the principal, the actual stock or the actual bond, and sell it or whatever. So in other words, your management of this stuff is to create income in retirement, actual income in retirement from different sources, qualified dividends, interest income, and so forth. Well, the first thing to say is interest income is taxable as ordinary income. If REITs or real estate investment trusts, a lot of people like them because they create pretty large amounts of distributions, but it's ordinary income. And so I'd like to point out that you don't have to get any distributions like that in order to take retirement income. So I want to give you another example here. So in January 2019, if you had $1 million in a Vanguard S&P index fund, you could take out 3% from this. Also, during that year, 2019, the S&P index, this is last year, went up by 31.49%. Okay, so at the end of the year, your $1 million would be worth. Well, if you took 30,000, it'd be worth $1,275,453. Okay, so in other words, in 2019, if you had $1 million in S&P index fund, at the start of the year is $1 million. At the end of the year, even after you took the 30,000, then you still had $1,275,000 in your account at that point. But the person says, well, I need to take out 30,000 because I'm going to take 3% of the value at the first of the year. That's going to be in addition to my Social Security. That's what I'm going to live on. I'm trying to take 3%. A lot of financial planners will say, well, you need to set a budget. You're going to take 3 or 4 or 5% out each year of your investment assets to live on. And you can take that amount, and you shouldn't run out of money because if we invest it right, it's going to continue to rise. That would be the idea. Does that make sense to you guys? Okay. So what I want to point out is that can be done very, very efficiently. So the first thing to say is this $1 million in this thing, it created $20,000 in qualified dividends. So this is about 2% of the value of it the first of the year, and you had to sell 30. So how much is the tax on the $30,000? My calculation was that if you the tax rate is 13.75 if you're in the 15% tax bracket for capital gains. It's 17.23% tax rate if you're in the 18.8 bracket, and it's 21.82 if you're in the 23.8 bracket for capital gains. So my point is that in many cases you could take distributions the way I described by actually selling a part of your account and take the distributions you need, and you'd be at a very low tax bracket. And part of the reason is that part of that money when you sell it is coming back as return of capital. Part of it is coming back as long-term capital gain, taxed at 15%. The return of capital is not taxable. It's the part that's coming back as long-term capital gain or qualified dividends that's taxable. So are you guys aware of that? In other words, you could invest this is an equity portfolio that's not creating very much income of any kind, and you're actually selling part of that account every year to take your distributions, and you end up in a low tax bracket. And you're having the advantage, if you were invested in bonds or CDs, there's no way in God's green earth they're ever going to appreciate like the rate that the S&P index fund might appreciate. Does that make sense? Okay, another thing that we should be aware of in thinking about taxes is step up in basis at death. Okay, so when you buy anything, whatever you pay for is its basis. So if you bought stock and it's $10 when you bought it, that's your basis. And if you sell it at 20, then the capital gain is the $10 increase in value, right? That's the capital gain, and that's subject to tax. Well, for some families, they have property or they have stock they have owned for decades, or maybe inherited decades ago, and the basis is very low on that land or on that stock. And if they sold it during their lives, they pay this big capital gain or capital gains tax. However, when someone dies, the property in your estate gets a new value. It's valued at date of death. Okay, so when someone dies owning property, the basis steps up to date of death value, and this permanently erases the capital gain. Okay, it's permanently erased. And so now, if the surviving spouse or the kids sold it, the capital gain would be from the date of death value to the value now. And so if that was done fairly close together, it would be hardly any or no capital gain. Okay, so step up permanently removes capital gain. Everybody aware of that? Good thing to know. Okay, it's a good thing to know. And this is why when sometimes people say, well, I want to give property or stock to my kids before I pass away. Well, if it's got low basis and we're talking about big money, you might want to think again about doing that, giving away that low basis, because if you give it away, your kids get the basis you had in your hands. So if you had Exxon stock that had a $10 basis and you give it to your kids get the $10 basis. If you die with it, they get the basis at the time that you died. Okay, so do you see what the difference is? If you die with it, it's a big advantage to your kids in terms, or your wife, your spouse.
When did that
Just
law,
don't
how
tell
has that
them.
law been in effect?
It's been in effect a long time.
That's what I thought. It wasn't any part of Trump's tax law or anything like that.
No, it's been in
Okay.
effect a long time. And in one sense, it's just a practical thing. Think how hard it would be to figure out the basis after someone dies. So in one sense, it's practical. Now, every now and then, the Democrats or others think it'd be a good idea to do away with this. And so when they're talking about state tax, every now and then they talk about doing away with that. But anyway, it's been in that way for an awfully long time, and it's a big advantage.
Are you going to touch on how the IRAs come into this?
Yeah, they don't.
Yeah, well.
It's real simple, they don't. Okay, so there's a few things that don't step up. And the answer is IRAs and 401ks don't step up. Well, why? Because no tax has ever been paid on those things. The IRS is not letting you get away with this. Okay? So, that's all.
Any good schemes?
No. Except to pay the tax at a low rate and convert it to a Roth. That's the scheme. Yeah.
What
Convert it to a Roth.
benefit if you have this stock that you bought at a cheap price, if you donate it to a charity, you can take the full amount that you donated and don't have to pay that increase.
That's right. That'd be another way to avoid it. And so some people that are charitably inclined, that's one of the angles on selecting assets for gifts to charity, and that is certainly a way of addressing that.
You know, to answer this question, something I've started doing, you can take your minimum required distribution out of your IRA, and you can give that to a charitable organization, and you never have to count that as income as taxes up front.
Well, I'm glad you mentioned that. I wrote an article about that, and I don't know, maybe in these slides, but since you brought it up, that is this is a good time to say it. If you're 70 and a half, I don't think you have to be 72 for this. They changed part of that to 72. I don't think you have to be 70 and a half. I think you only have to be 70 and a half still. No, you got to take the minimum required distribution.
And you got just go. It changed this year. You're 72 after sometime this year.
Well, anyway, so if you're taking minimum required distributions, you can send that money straight to a charity. Okay, and one advantage is the charity doesn't have to pay taxes on it. The second advantage is that it operates as a tax deduction for you. Okay, but remember before, in order to get a charitable deduction, you had to get it on the Schedule A, and it had to be over those thresholds to make it worthwhile, over the standard deduction to make it worthwhile. But if you do what he just said, the direct payment from your IRA custodian to your church or to the charity, then it doesn't here as part of your adjusted gross income. And as a result, it is the equivalent of getting a tax deduction for it. Okay, so you don't have to use Schedule A. So the trick is you have to tell the IRA custodian, Fidelity or Vanguard or whoever it is, I want you to send the check, I want you to make the check out to so-and-so. And it varies from financial institution, but what some of them do is they will send you the check, and so you can give it to the institution. In other cases, they'll send it straight to whatever the institution is, the church or whatever, and then you need to know that you need to have a notice of this so you can report it on your tax return properly. But the point is, it doesn't count against as part of your AGI. Can be deducted. So this is a super technique. So anybody that's making regular, big contributions of church or charity definitely needs to consider that. But and also you're not limited to minimum required distributions. It's up to 100,000.
I didn't know it is, okay.
Okay, now, okay, I need to mention a couple other things on this. I made that. I don't know if there's another slide on this or not. Okay, so for many people, many couples, in your estate plan, it says when the first spouse passes away, the trust splits, okay, into two. And one half of it is the survivor's trust, which is a continuation of the living trust. And the other half is the family trust, which holds the deceased spouse's half of the property. Okay? Well, the property in that trust doesn't get a second step up. Okay? If the trust was done before 2016, since about 2016, we've been putting magic language in there to cause a step up on the family trust. So let me drop back for a second. Here we got mom and dad. Dad passes away. All the property steps up, all of it. Okay, now this is another advantage of Texas community property. If you live in a common law state, this doesn't apply. But in Texas, all the community property steps up. Okay, so for many clients, everything in their estate steps up at the first death. Okay, but the problem is if you have that family trust, or if you have a really old planning where you had a credit shelter trust in a will or whatever, the property that goes into that credit shelter trust or the family trust, in the old days, it never stepped up. It didn't get a step up on the second death. It didn't get a step up on the second death. But now we can put magic language in there, so the whole estate will step up twice. Once when the first spouse dies, and once when the second spouse dies. Now this is no small thing in certain families. Okay, just for example, not too long ago, we had a family, and the husband had passed away in 2005 or 6, and he worked for this company for many years. And when we funded the family trust, it was filled with this stock, okay? And it got a step up when he died, right? But anyway, it was funded with this stock. Well, since 2006, that stock has gone up like a bullet, okay? And and now mom has died. The family would dearly love to have a step up on that property, that stock that since dad died. And if we had gotten with that family before mom died, we could have fixed it. But once she died, we couldn't fix it. Okay? So they missed that step up on that. So if you have family members, you know somebody, and they've got an existing, where one spouse has passed away and they got that arrangement, probably they need to come back in and see us about setting that up so that trust will step up on the second death.
We did our trust review sometime in the late 16, early 17. You think that language might be, I need to go check, see if that language.
We need to check, yeah.
Okay.
Yeah, and that's one of the reasons I want to mention it. If you have any questions about it, there's some strange language in the family trust provisions that do this.
Okay.
Now,
Yes, sir.
life insurance proceeds that go to whoever it goes to is not taxable, is it?
Correct. Unless you really screw up, it's hard to do that. Fortunately. Okay, so anyway, I wanted to tell you about that step up business. Okay, now remember that when they passed that tax law in 2017, there were a lot of people said, oh, this is wonderful, and a lot of people said, oh, this is horrible, okay? And the reason that people said it was horrible was that the new tax law limited write-offs for state and local taxes to $10,000 per return, okay? And so what this meant was that in California and on the East Coast and all those high tax states, so they had high income, state income taxes, and they had property taxes, right? And so what people have been doing is they had humongous standard deductions. And so in effect, the state could tax the person a whole bunch, but it was offset on their federal tax return because they got a deduction for it, right? Well, when they cut this thing to $10,000, all those people in New York and New Jersey and California just screamed bloody murder because now, and also the governors and state officials, because now all their citizens were complaining about the miserable tax load that their states had. And so this is why there was a lot of howling about it. Now, it could affect Texans that have big houses and stuff as well, obviously. But at least in the people that I've talked to and the tax returns that we've seen, nearly everybody paid less taxes on the 2018 than they did in 2017. So for most people I'm aware of, it really was a tax break. And for small business people, some small business people, it was a humongous tax break because of that 20% deduction off of the small business taxes. At any rate, okay, this is where we're going to have that slide about the IRA owners who are 70 and a half or older can make distributions straight to the charity. But the warning there is you can't take the distribution yourself and then turn around and give it to the church or the charity. It's got to go straight from Vanguard or straight from Fidelity to the church to make.
You know, it also cannot come from a 401k. It's got to be an IRA.
Oh, that's right. That's right.
Yeah, found that out. Yeah.
Okay. This also affected young families because they increased the child deduction. So it went like this. In 2017, the credit for kiddos was $1,000. They doubled it, and they also changed the phase out, so more people could qualify for a larger amount if they had kids. And if they were very poor, they increased the refundable amount for people that don't pay any taxes. So this is sort of a negative income tax that was actually providing more money for people that don't pay taxes. Okay, now I don't know, most people that I know of are not affected by the alternative minimum tax, although it always gets a little bit of press attention. This says that only 50,000 filers earning between $100,000 and $500,000 are expected to owe AMT for 2018 compared with 4 million in 2017. And there's two tax rates for the alternative minimum. One is 26 and one is 28. So you say, what in the heck is this thing anyway? It was designed for people who, well, here's a good example. Let's say somebody had a lot of money and they decided they were going to invest in tax-free municipal bonds or tax-free bonds, okay? And so they were gaming the system in a sense, right? I don't want to pay any income tax. I can't stand the government. I'm going to buy these tax-free municipal bonds or whatever. Well, that would still work if they were all tax-free, but there's a lot of municipal bonds that are called private activity bonds, and if you have those, then under the AMT, you have to pull that money back in, and if you haven't paid enough taxes already, then you get hit with 26 or 28%. It can also happen to people that have a lot of capital gain. It can also happen to people that have a lot of children or a lot of deductions, okay, can hit the AMT. But basically the idea was, if they didn't think you were paying enough tax under the regular rules, oh, we've got another tax system for you, and that's what AMT was. All right, 529 education savings accounts. So this actually went into effect in 2018, but just to remind you that it can now be used for private school tuition. And so it seems like more people are doing private schools. This may be real helpful. And it also can be used for these ABLE accounts for disabled people. They've got a lot of press when they first came out, but I haven't really seen much use for them on
Is
that.
that 10,000 per year for private school, is that a normal amount that's charged, or is it higher than that?
Oh, no telling. Yeah, and some of those schools are high as a kite. Oh, yeah.
Even the K to 12, huh?
Yeah, like that, what is it, what's that one, the Cooper School out there in the Woodlands where you live?
John
Cooper?
Cooper, yeah.
You know, I don't, it's, I'd say expensive as a major college.
Wow.
Contributions tax deductible? No.
Or
No,
what?
no.
529.
Oh, no, they're not tax
That's
deductible.
what I thought.
It's after tax money.
Yeah.
Okay, estate taxes. So last year, it was 11.4. And this year, 2020, it's 11.5 something per person. So your estate tax exemption is 11.5 something this year. And so if you're married, that's over $23 million you can leave to your kids with no estate tax. Okay? Now remember, when I started practicing in the 1990s, the estate tax exemption was $600,000 per person, and every middle-class family had a tax problem. The part of the tax problem was that, and that's why there were so many of those family trusts, those credit shelter trusts they call them, because under the law before 2013, if I left my half of the estate to my wife, my estate tax exemption, my $600,000 estate tax exemption in the 1990s went poof. And now my wife had one exemption. And if the total estate was over $600,000, including IRAs, 401ks, life insurance, and everything, well then, when she died, all the part above $600,000 got taxed at 40%. And so everybody was, so anyway, so it used to be everybody had an estate tax problem. Now almost nobody does. If you have an estate tax problem, you're blessed indeed. Count your blessings. But here's the thing: if we're walking around today, we're probably not going to get to take advantage of this. And the reason is that in 2026, under the current law, it will drop back to what the old law was, adjusted for inflation. So it means that in 2026 and beyond, as the law stands now, you're going to be at 6 million. And so anybody that's above 6 or maybe over 6 is going to start to be an estate tax country in 2026. And also these Democrat tax proposals are all talking about cutting us back or changing these laws. So no telling what we'll have in the future. So it's nice now if you pass away in the next few years, but I don't know how long this is going to last. So we just have to. Now here's one other thing to take away. For families that really have a lot of money, well, they need to do some stuff right now to take advantage of it. So I don't know whether that applies to anybody here, but people that are really wealthy, what they would do is they would create a family partnership or family LLC. They would put a bunch of their assets in this thing because that will lower their value for estate tax purposes. Then they would take, let's say it's a married couple, they take, each spouse would take $6 million. Let's say the couple had $24 million. So each couple takes half of take $6 million, because they're trying to get it down to 6. Take $6 million and put it in this family LLC, and then take the family LLC and put it in a trust for their kids. Okay, that's the plan. That's what you do, because this would allow the couple to use half of this exemption. If their thinking was they would always have 6, but they're not always going to have 12 or 11. Then we're going to give the amount over 6 to our kids now and take advantage of this current estate tax exemption. Because remember, the gift and estate tax go together. So you have $11 million estate tax exemption. You also have $11 million gift tax exemption. It's not two things. It's just one thing. You can give away $11 million while you're alive. You can give $11 million when you pass away. But if you thought it was gonna go down, you take part of that and give it to your kids now. Does that make sense? You're thrilled with that idea, right? But it would make sense if you had a certain amount of money. Keep in mind, see, the family can control the assets that are in that family LLC, and potentially they can control the assets that are in those trusts. So it isn't necessary that the money just be dumped on their kids at this point. Okay, let's see. We're going to talk about the Secure Act. Okay, this was one that actually came up. I mean, what we've been talking about before is the tax law that actually went into effect at the end of 2017 for 2018. So we already had that for a year. This just came up. This is the new Secure Act. And so let me see what I've got here. So the main idea is that this doesn't affect spouses, but when an IRA goes to your kids, they have to take it out in 10 years. Okay. So what changed? Well, for more than 20 years, clients have been expecting to be able to leave their IRA to their kids, and their kids could take distributions out over the kids' life expectancy. Right? Is everybody on? So this made it very desirable because the IRA could grow tax deferred. The part they didn't take out could grow tax deferred for decades potentially. And so the way this, and the other thing to say about it, let's say that the parents passed away and one of their kids was in their 40s. The 40-year-old kid probably has a 40-year life expectancy. There's a table, whatever it is, it's probably 40 years. So that means that the kid could take out 1/40th the year after the parents died from this IRA. The next year, 1/39th and so forth. Okay, so he'd have 40 years to take this out. And the first year, 1/40th is like 2.5%. So if the kid wanted to, he could take out only 2.5%, and the rest of this IRA grows tax deferred. And he takes out another minimum required distribution the following year. He has to take minimum required distributions beginning the year after the parent dies. But anyway, that was the whole deal. And so for many clients in Houston area, their biggest asset was the IRA, and they figured, well, if I don't use it up during my retired years in minimum distributions, whatever's left can go to our kids, and this is such a great thing. And so naturally Congress changed this. So this says the House passed it in December 17th, and the Senate passed it December 19th. But actually the House first, yes, sir. The House actually passed it back in May, and there was a big ballyhoo about it back in May when they have a conference committee. That's why it was finally finished up in December. But the House first passed it in May, and the Wall Street Journal and everybody wrote about it, and they said this is such a breach of faith. Everybody's been doing this planning all these years to be this way, and they shouldn't do it. And for a while I thought maybe that they would think better of it. But right before Christmas they passed this thing. And so it had a bunch of provisions in it. But some of the main things it said that R&Ds, which used to start at 70.5, now can start at 72. It said that you can continue contributing to IRAs as long as you're working. You used to have to stop. It says 401ks can now cover part-time employees without working 500 hours. And it says it set up penalty-free withdrawals for birth or adoption. But the biggest change was that, well, another thing to say about it, there was no period to get your mind right. They passed it in December, and it went into effect December 31st. And so it was there and went into effect. And so you start required beginning distributions at 72. But the big deal, the thing that messed up the stretch, was that the money for the kids had to come out in 10 years.
Does that also apply to Roth?
Yes. Yep, have to take out in 10 years. Now, who isn't subject to the 10-year rule? Well, like I said, it doesn't have any effect on spouses. Okay, those rules are all the same. If the beneficiary is under the age of majority, it doesn't apply. But once they get to be 21 or whatever the age of majority is in this act, then they have 10 years. But if you had a situation where an IRA went to a grandchild, then they would be under that very long period. You know, it might have 70 years to take it out. But then once they get the age of majority, then it has to come out within 2 years. If the person is disabled, the rules don't apply. And then this other one is an individual not more than 10 years younger than the participant. So if, for instance, in families where if they didn't have kids and they were leaving an IRA to their brother or sister, then the brother or sister who was not more than 10 years younger could do the stretch. Okay? But for most of my clients, where they were counting on this for their kids, then this messed that up pretty thoroughly. Okay? And that, so there's a couple of examples here just to let's see what IRA going to spouse, no difference from the pre-Secure Act plan. IRA going to a brother who's 9 years younger, no difference from the old rules. Planning for special needs beneficiary, no difference. Disabled or chronically ill, same thing. Okay, this is kind of pointing up the problem, okay? So this language, this FRPT, that is the IRA trust. So if you have a trust with us and we create an IRA trust in your trust for your kids, that's what that is. And so this says if Johnny has one of these IRA trusts, he's going to have the right to withdraw distributions from the IRA, and everything's going to have to come out by the 10th year. And if the family thought that was a poor idea, one, that he would have the right to take the distribution when it came into the trust, or that the 10 years would encourage all the money to come out, you might say, well, that doesn't sound like a very good idea. And so the trust could be changed so that the distribution did not have to go out to the beneficiary. The distribution could stay in the trust. But this means that the distribution is likely to get taxed at higher rates than if it went out to your son or daughter inside the trust.
Wait a minute. I thought that the advice was not to pull your IRA inside the trust.
Well, in your planning, it may be that way. The issue, so remember, for many clients, the spouse is the primary beneficiary for 100%. And your kids, grown kids, they can be the beneficiary straight away to them, okay? And that is simple. But many of our clients, the primary beneficiary is the spouse for 100%. The contingent beneficiary is the trust or the trust for the kids.
All right.
These
Right,
retirement benefits.
my question is, my IRA is not part of my trust, though, I didn't think.
Right, it's not part of your trust because it has to be under your name as long as you're alive.
Right, okay, all right.
Okay, and then the primary beneficiary needs to be the spouse, because the spouse can do this rollover.
Right.
The spouse has more flexibility in taking distributions than anybody else. But the reason, and then when it goes to your kids, if it goes straight to them, then that's relatively simple. But if it goes to a trust for your kids.
That's what we got, the trust is the
Yeah.
contentious.
Right, so if you do, the reason you do that is primarily, for most of my clients, I think the reason is for divorce protection. And also to make sure it continues in the family bloodline. Those are the two reasons that it's going to the trust. Okay, so then when you have that planning, our goal was not to create a tax problem. And so the way that, remember the IRA's got all kinds of rules. So if an IRA, if a trust is named as the beneficiary of an IRA, the trust has to have the right language in it. And the language that's in these retirement benefits trusts is that that whatever the trustee takes out, takes from from the trust. And it might be your son who's the trustee, so he's taking the minimum required distribution, he has to take that. And then the beneficiary has the right to take the distribution, the right to take it. Okay? So if you had an irresponsible kid, the trustee might be, just taking minimum required distributions, but the kid can take the thing, and it has to be worded that way in order to get the stretch of these rules. Well, now it's going to have to come out in 10, well, it doesn't have to come out 1/10 a year, but you probably want it to come out 1/10 a year just to keep everybody in a lower tax bracket. It could, you don't have to take minimum required distributions under this 10-year rule. You can take it all out in the 10th year. But then that means all that money is going to hit somebody's tax return in the 10th year, right? See, we can get. So anyway, so the point is we have special rules in there, and if you were thinking that you wanted your kids to take distributions of 3 to 5% from this inheritance that they receive and maintain the inheritance out into the misty future, this isn't really consistent with it, right? It seems like it's dumping the IRA, and it's forcing it out faster than you intended. It's creating a bunch of tax quicker than we intended. And so some people are going to say, no, this doesn't really fit what I was hoping to do. Okay? So this is also leading, and the other thing it leads to is that maybe we should do Roths. Okay? So the Roth, if we could convert it to a Roth, the kids still have to take it out in 10 years. But it's growing tax-free. And when they take it out, it's tax-free. Okay? So now you've really created a tremendous advantage for the kids with the Roth over this regular IRA. And so this is why I wanted to mention something else about it. So remember we were talking about in that first slide, we were saying that it was 25% bracket at 153, but now the 24% bracket goes all the way to 321, right? So if you're in retirement and you're in a low tax bracket, maybe what you want to do is not only take your minimum required distribution, but convert part of your IRA every year to a Roth while staying in the same tax bracket. That make sense?
Mm-hmm.
So if the retired couple is in a low tax bracket and you got this lot of width in it, you could say, well, I'm willing to pay 12 or 24% or whatever it is. In some cases, your kids are not going to be in that low a tax bracket if they ever inherited it. So you're really in a better position to do this than they are. So I think a lot of people are going to relook at Roths if that works. Some people, if their IRAs are so big, it just creates a giant tax problem any way they do it. But for other families, it seemed like it would work, and that the Roth is so much more desirable that we ought to be switching to Roths. We can stay in a relatively low tax bracket. So the benefits: completely free, tax-free earnings, never too old to contribute, never subject to R&D. Another advantage is if you're taking money out of your IRA, your traditional IRA, and converting it to Roth, well, that lowers the amount of your minimum required distributions in the future, presumably, because it's taken, you're calculating every year, you're doing a divisor into the value of your traditional IRA to calculate your minimum required distribution. Well, if you're reducing the size of your IRA, the amount you have to take out is reduced. And you don't have to take minimum required distributions. You don't, out of your Roth. So it can just, if you don't need that money, it can grow tax-free for you and your wife's life without taking any distributions. And then your kids get it. They have to take it out in 10 years, but it's growing tax-free and principal's tax-free. And so they could wait 10 years, potentially, letting it grow tax-free for 10 years, and then take it out, and now it's an after-tax asset that they got tax-free. That make sense?
You pay about 25% to convert to a Roth, and hopefully it'll increase 25% by the time it's
No, that's another good point. Yeah, exactly. Yeah, not only that, but if you convert it now, it's got all that time to grow.
Yeah.
And to replace the cost of the tax.
Ideally, to convert early, and that way you keep adding to it as you're working, all tax-free.
Okay, so how do you do a Roth? So, of course, right now we were just talking about people who already have a big IRA and probably retired, but you can open an account, and of course a person has to be the owner of an IRA. A trust can't, or a Roth, a trust can't be the owner. There's no such thing as two owners of an IRA, and they have beneficiaries, primary and secondary. And there's two ways to create Roths. You can contribute if you qualify, or you can convert. So to make contributions, it's $6,000 if you're under age 50. It's $7,000 if you're over 50 under the rules in effect now. There's no age limit on contributions. Minors can contribute. You have to have earned income in order to, and you can only contribute earned income. You can always get it out penalty free. There's a phase out at 122 and 193, and then you can't do the Roth, okay? So in order to do a Roth, in that case, you have to do a backdoor Roth. Let's see, this is slide on the backdoor Roth.
It's mentioned there.
Yeah, okay, here's it. So, so the way you do a backdoor Roth, you know, there's thresholds about you can't do a traditional IRA if you could cover it and you make so much money. So, but here's what you can do. You can do, even if you were above all the thresholds, you couldn't do a standard IRA. You can still make this work. And the way that people do this is they do a non-deductible IRA. So if your kids were in a high tax bracket, so they can't do these straight away, then what they do is do a non-deductible IRA contribution and then immediately convert it to a Roth. That is the backdoor. Okay, that's how you go. Does that make sense? So I've had a number of clients that were doing that every year. So that's how you do a backdoor. Okay, so why are we interested in the tax law? Well, of course, we don't want to pay unnecessary taxes. We don't want to be a boob and find out we did something dumb, right? Nobody wants to do that. And we also want to be aware of possible tax savings, and we want to increase our investment returns, and we want to be good stewards of our life savings. So there's a lot of reasons for being interested in taxes. So let's talk about one thing, just to kind of roll something around in your mind. I had a situation that I encountered where the client had considerable resources, and he put his retirement in tax-free muni bonds. Okay, and so then the income that was coming in for the most part was not taxable. And his thinking was, well, my principal is still going to be there, and I can use this money and not pay any taxes. What could be better than that, right? So do you see any problem with this? Or is this just an act of genius? So Jerry said inflation. That's exactly right, okay? Because, and there actually have been really celebrated cases of this, of application of this. For instance, around the turn of the century, there was one of the railroad barons put some ungodly amount of money into bonds. And then, by the 1930s, his kids or grandkids at that point, living off this money, they were becoming impoverished because the inflation over that period of time had decreased the value of their distributions, the purchasing power, dramatically over time. And so we can't lose sight of the fact that we're always fighting this inflation problem. And And so then you say, well, wait a minute. If I'm in retirement, I'm thinking about this investment problem. What I want to do is find out where I can get the biggest return with the lowest risk. And so there's oftentimes talk like somehow you could get a huge return with no risk. But in terms of just investment theory, this is not possible. Bonds as an asset class are never going to pay as much in the long term as equities. And so in these portfolios, you need equities if you're going to get enough appreciation to offset inflation. So another thing that one of the rules, have you guys heard this? One of the rules of thumb are that when you retire, the idea is that when you retire, then you just want to have a peaceful life. And so one of the rules of thumb is that you're supposed to have bonds up to your age. So in other words, when you're 70, you would have 70% of your portfolio in bonds and 30% in equities. This is one of those rule of thumb solves that you hear about, right? So what do you think about that?
Yeah.
Well, good. You're not falling for this.
A 30-year bond paying what, 1.75% interest, you don't make much money on your bond.
Right. Well, and also, and I don't think I have it handy, but I was looking at a table that showed the worst 5-year returns, on these asset classes. And it was looking at one of the portfolio, the asset class portfolio was 95% stock and 5% bonds or cash. And that combination is very volatile. Okay, so it would give you, if you don't like big stock market moves, that's not the one to have, because it's gonna crash when the market crashes. But its long-term returns are high. But at any rate, back to my thought. That particular portfolio, 95.5, what was its worst year? Worst 5-year period? It was 2007 to 2011. And they were talking about a period of, 40 or 50 years. The worst 5-year period was 2007 to 2011. You know what the result was? It was like a loss of less than 2%. And the other portfolio, 75 stock, 25, they had a slightly positive result in that. The worst period was 2007 to 2011. So if your worst result with a properly structured equity portfolio is that small a loss, how would that be less safe than a bond portfolio? Right? How can that be less safe? It's not less safe, it's better, because your long-term returns in the equity portfolio much exceed anything you can expect from a bond portfolio. So what does safety mean? The fact that your portfolio doesn't move from day to day I guess that's what it means. But at any rate, that just points out what I think is a flaw in that thinking. I'm thinking that for us in retirement or thinking about our investments, that on average, what we're looking for is we want to be able, over the long term, to distribute 3 to 5% of the portfolio value, and that means we have to get 6 or better on average, year in and year out. If you do that, the money never dies, never goes away, and so then you have a great legacy for your family. And I know most of you are trying to do that too. So, but at any rate, it seems like to me that's the kind of the way to think about it. Your distribution rate needs to be less than your expected return, and it doesn't make any sense. If you've got to have distributions you want distributions of at least 3 to 5%. So you've got to get above that. And this is the other thing, this is another thing that makes me sad, is the average equity investor in the United States gets between 3 and 4% over the last 30 years. The average investor in stocks gets between 3 and 4%. If they just bought the S&P 500, they just held on, they'd get closer to 10. So why is that? Why is that? It's because people are getting in and out of the market. They're changing the mix that they have in their portfolios. They get scared and go to annuities and CDs for long periods of time, make it for all. And so that's why they don't get the returns. So we need to have a good steady approach and good tax planning as well. Let's see. Other questions and thoughts on this? If there are other things y'all have been looking at your taxes, did something else come up that was a question? So.
No, I realized I gotta do something about my IRAs and get them converted to Roth. I need to learn how to do that.
Yeah,
Because,
so what is that slide back here is the first example of this. Okay, I was looking at somebody's tax return, and their AGI was between 78 and 168. That means their look at this, the marginal tax rate was 12%. Well, if you're, let's say their AGI was $100,000, they could do another they could convert another $68,000 of their traditional IRA and only get taxed at 12% on it. Nobody's going to be in that. It's unlikely the kids are going to be in a 12% bracket. I mean, I don't know, but it seems like to me that that's probably well worth considering if you can get that money out of there at 12%. Because just think about it, in the great scheme of things, the IRA was always it was really a lousy asset for your kids, for a lot of reasons. It was a lousy asset because it always had taxes involved in it, and it always had its own set of rules. And the after-tax money, or these Roths, are much more flexible if you're interested in this continuing on for the kids, or even for your own management retirement. It's easier to handle if it's in these other categories. So I think that's something to really consider, and I'm certainly going to, until this hit home, I really wasn't thinking about doing that, but I'm certainly thinking about it now.
But whether it's Roth or standard, you still gotta make sure you got the right investments there that
Yeah,
can
exactly.
increase.
So I don't know if I don't think I have anything else today. Oh, well, let me mention a couple things. So you came in today, and we appreciate it very much. And so some of you have trusts and questions. So I don't know if we need to call, or you would like to make an appointment on that. By all means, if that's of interest, we'd like you to. And she's got a sheet there, and it's even got a few times that are available for that. If you'd like to talk about investments and financial planning like that, sign up and indicate that on the form, and we'll be glad to help you on that. And if you have tax questions or something come up, give me a phone call about that, and we'll chase it around.
And there's only one other fun announcement, and that is, anytime y'all would like to, if you would like to go on Google and search the Bond Law Firm and tell people how wonderful we are, we really enjoy when y'all do that.
Okay. Thanks, Mary, appreciate it. And then, let's see, the next obstacles presentation is
March 25th at 1:30 p.m.
So it's right here, so that's a couple hour workshop on the investments and family planning.
Okay.
Estate planning or having children?
It's on taking care of those kids, taking care of them.
This is March 25th, you said?
And for your information, your emails that you send out, I enjoy them.
Well, good, thank you.
and hey, it keeps me alert and tells me what's happening.
Well, it's, and the news is, now is so, there's so much news, right? It's just amazing, you know? And there's a lot to keep up with. Well, I'm glad you like it, so you know, we have our own slant on things, so maybe that's a help.
So we also got your flyer with the different seminars coming up.
There's a
We have a
blue
couple of
button
friends that
there.
are interested.
You
Can
think
we
you could
bring
hit that
them or
button?
send them?
If I
Okay.
don't knock it over first, just to turn
Oh,
it.
so it's down 2,100 now.
What's that?
8.87%.
Well, I'm adjusting the volume.
Now listen to this.
Are you wanting to stop it?
You know, I always preach now that you need to be.
How about if I just do
asset
that? Yeah.
classes, you need to be broadly diversified. But, you know, for years and years, I was a stock picker.